First of all, why are we doing this event in Hyderabad? We have to answer that. And when we did our city events with CGTMSE in Delhi, we had, you were there, sir. We had a similar kind of fallout, and a lot of people were there. And they had so many questions on funding. And this is supposed to be the most important panel because it's a panel about decoding fundraising. We got 180 odd registrations for MSMEs, and I think I'm seeing so much buzziness and activity in this room. Like, I am like floored away with the Hyderabad entrepreneurial enthusiasm. Now, what exactly are we trying to do in this panel? When you say MSME, it basically is micro and small medium enterprises. The government has given different nomenclature, MSME, startup, but let us talk about it as a company, say less than 5 crores is what we are looking at. Now, if you have to do a fundraise, why would you look for an angel investor early on? Should you not look for something which is maybe debt, but a debt which comes at a subsidy by the government as a support capital, take your company to a certain level, and then perhaps command a better say through the VCs and the angels and the investors? Because what is happening is that everybody is overawed and wants that $100 million as the first check, but that does not really happen. You have to understand that getting into the cap table of a startup is a very high risk proposition. And you're a 2-member team, you're a 3-member team, and somebody is getting there. I want to begin this panel with Mr. Murthy from CGTMSE perspective, and like wanting to understand from him that if a startup is growing and up to a level of 5 crore, how can they help them? And then perhaps get you, Siddu, in terms of understanding equity versus debt. Now we also have a new animal called venture debt. So there are different fundraising avenues available for startups. But I'm not sure how much do people really understand that from a risk and reward ratio. Because what is happening in media right now, that there's so much being written that people have to get clarity. And we are here to provide you that signal in the noise. Think of RizingTV as a platform to provide you a signal in the noise. And Mr. Murthy, sir, I would like to sort of have you to talk about, if I'm a startup up to 5 crores coming to you, what really can I expect from CGTMSE?
Namaskar. First thing, I think I was hearing to many people that I want to clarify one thing, that CGTMSE is not a lender. It's a guaranteeing organization. This is very first this one, because many people are asking how much you are ready to lend like that. So the question is that we are not a lenders. We are a pure out and out guaranteeing organization. This is first thing. And it is a CGTMSE is a trust established by Ministry of MSME, Government of India, and SIDBI, Small Industries Development Bank of India. So our basic job is that any viable project is not sanctioned by any banker for want of security. At that point of time, banker can approach us for guarantee purpose. We give guarantee by charging some guarantee commission. Now when I am saying this, how much guarantee we are going to give and all those things, then I am guaranteeing from in the range of 75% to 85% guarantee we are giving of the term loan to the tune of 5 crore rupees. If somebody is taking a term loan of 5 crore rupees, we are going to give guarantee up to 75% of that amount for certain set of people, and 85% of guarantee for SC/ST, women and other northeastern and other sector of people. So this is purely our mechanism. Now the question is that who are all eligible to get this guarantee? Everybody is eligible to get this guarantee. There is no what you call negative list in my case, and we give guarantee to all the people. We don't look into that whether it is startup, greenfield, brownfield, or equipment funding, all those things we don't look into. We give guarantee to all the people. And if I have to say from activity point of view, only 2 things are not eligible as of now. That is a pure agricultural activity and self-help group people. These two are only not eligible to get guarantee from CGTMSE. Another question, one more thing I'm hearing from various people that banks are not inclined to give a loan under CGTMSE. Just I want to put forth some of the figures that last year we sanctioned a guarantee, approved a guarantee of 2,02,000 crore rupees. And last year alone we given this guarantee to around 18 lakh borrowers. And this year in 151 days time, that is a record-breaking figure. That is 1 lakh crore of guarantee we are given this year, covering around some, I don't remember correct figure, some 10 to 12 lakh borrowers. This year alone we are given that. And this year our target is that based on the inputs what we are getting from various banks, that roughly we would be touching 3 lakh crore rupees as guarantee for this year. So I can say banks are giving guarantee and banks are ready to cover the loans under guarantee scheme. So for any reason, if somebody is refusing not to cover some loan under this one, definitely CGTMSE is not the reason for that. Any other reason could be. And this is one more point we are hearing from various sections, that the rate of interest if any account is covered under CGTMSE is high when compared to collateral security. So for this also, in fact, Minister of MSME and Reserve Bank of India, these two departments also asked us why it is happening, you look into. In fact, we written to all the heads of the banks that why it is happening and what are the reasons you are attributing. I'll tell you about why the interest rate should be less when compared to collateral security. Is that the bankers, whatever loans are covered to extended to micro and small sector people, as per regulatory norms, they have to give some capital charge, first thing, and they have to make provision. Even for the standard account also, they have to make certain provision, which are the cost included in the interest rate. Being from risk point of view, these two things are also added to the risk component. To that extent, the rate of interest will go up. Whereas in case of CGTMSE coverage, there is no capital charge and there is no provision to be made by the bankers. That is why the capital cost and the provisional cost is coming down to those people. So naturally the rate of interest should be less to CGTMSE cover cases. And one more thing I heard that some of the banks, they are not aware, the rates of guarantee commission has come down like anything. The lowest rate right now is 0.37%. The highest rate is 1.35%. So the vis-a-vis, when you compare collateral security vis-a-vis the CGTMSE, if you take, collateral security also has got certain rules and regulations for each and every bank that periodically you have to visit. There is a charge attached to that. Title search you have to do. There is a charge attached to that. Valuation you have to do. There is a charge attached to that. So some banks, they are collecting a uniform regular, that is at regular intervals, they are recovering certain charges. Whereas in case of CGTMSE, you are going to pay a fixed commission throughout the repayment period on the outstanding amount. Say suppose 100 rupees is the outstanding, first year you would be paying the guarantee fee on 100 rupees, and the second year onwards you would be paying only on the outstanding amount. So it is on reducing balance method, your guarantee commission charges also will come down like anything. So these few things I heard from various sector of people. So these things are myths only, it's not facts at all. So if anybody is saying that CGTMSE loan is costly, you need not argue with the gentleman. You can go to the CGTMSE site and there you can see my guarantee charges. And you can show to them, those people, and not a single pi more or single pi less we will accept than that guarantee commission. And the only thing is that on that 18% GST will be there. You can add and you can arrive at the GST, guarantee fee charges. And rest of the thing is charged by bank. Then you can very well ask the bankers why you are charging on a higher side. So this is about this one. And one more thing I heard from various sections that CGTMSE is not settling the claims. And I will tell you, last year we settled around 2,634 or 37 crores. So you can see per month how much it is coming. And this year, only 6 months time only completed, we have settled around 1,224 crores. Right? So from CGTMSE point of view, there is no issue at all in lending anybody. I mean, I don't say X I will extend the guarantee and Y I don't extend. There is no such bar for anybody. Anybody and everybody can avail the guarantee from us, provided your banker has agreed. And another thing I will say, when I am saying all these things, I cannot say to any banker, I am ready to give guarantee, you lend loan to this gentleman. Because that is not in my this one, and even Reserve Bank of India cannot say that. So, why banker is rejecting, how banker is rejecting, that is beyond my purview, I cannot comment on that. But as far as guarantee purpose, guarantee point of view, I can tell you that we are ready to give guarantee for all the MSE loans without any bars.
Right. Thanks for that, sir. So that's a very important point, because there are a lot of myths that are connected, that debt is bad, equity is good. Perhaps one needs to understand that when you are a startup and you are growing and scaling it, there are different kind of capital requirements that come into your life cycle. And you have to be very prudent about that now. A scheme like CGTMSE, and there are various success stories about it. And you will hear about some 2 or 3 of them in this event today. Because I would also come to you now, Anil, as part of your fund, that there are a lot of startups which are actually non-fundable. They should not raise funding. Basically, it's an idea stage or a product stage. And basically, these companies are still figuring out. In fact, there are some businesses which are not meant for VC or angel funding. It could be a good lifestyle business which you can run on debt, right? So there might be a lot of chances, maybe in your life cycle, where you would have to say no to funding because that business was not meant to raise external capital. So perhaps there are some businesses up to 5 crores which are only meant to raise debt capital. What is your personal advice in this direction?
It's a very tricky question that you have asked. The founder of any idea really believes that he can start off with a couple of lakhs. And for him to raise capital from, or for him to raise debt from financial institutions is quite difficult, because he's a youngster who just has no track record, and he's got a good idea. That's when they come and approach us. So we support at an idea stage itself, not even proof of concept. Huh? Please believe me. So the criterion is, you've got an idea, you want somebody to believe you, you believe yourself, you come to us, so fine, sit down with us and we will evaluate this. Therefore we call it as the Idea School Fund. We created an Idea School Fund of $100,000 and we back up at least 10 to 15 such ideas every quarter. So that is the first stage of actually idea stage. Now then comes in a stage where they would have a proof of concept in an early stage. They have got an idea, they have proved it, yes, it is viable, it is, or rather they have proved it, yes, it can work. And then they would like to raise funds. Again, would they want to go to the financial institution for 5 crores, up to 5 crores? No, they would not. Because at that point of time, for them to grow, they probably require something like maybe 1 crore of rupees. Maybe lesser than that at the early stage. Now at that point of time, they again approach us and we validate it. We have a very huge democratic process. We validate all those ideas. We sit down with the investors again and we make them part with some kind of capital to the tune of, say, now right now we are handling a ticket size of, or rather a deal size of $500,000. That is 4.5 crores. We are handling right now. That is one of the. Now, when does a founder go for a debt? I have no clue. Why would he not want to go for a debt? No clue. But why would they want to go for equity is because in the past few years, there has been a general opinion created, thanks to media, thanks to Shark Tank, thanks to our Prime Minister, thanks to various other things that have been conveyed to the people. What's happening is people assume that raising equity or diluting their equity and raising funds through angel investors like us or venture capital micro VCs like yours is much.
It's much easier, they
No,
think.
no, they assume. I'll tell you something which is very important among the crowd. If there are any startups, let me tell you one thing. We are not here to make friendship with you. We are absolutely against your interests. We are adversarial. Our interests are adversarial to your interests. We just would like to make money in the next round. Trust me, my colleagues will agree with me.
That is the most capitalist statement coming from
That's
a
that's
VC.
the truth. The truth is that why would I? You see, I receive something like 15,000 applications a year.
Wow.
We receive 15,000 applications a year, and I can hear to something like 150 startups I hear, and I lend to 50 people. In the last 4 years, we have lent to some 200 people, totaling an amount of 800 crores. So where is that? Where is that? Where are we? So what is happening to the rest of the 15,000 people? They are still believing that they will get funding. That's the irony. That's what I would like to say.
That's very well said, Anil. So, Anil, like to the criteria that you have said, it's a large book that you're handling, especially in the idea stage. So, are there any established parameters? Like, how do you distinguish from one idea to another? Like, are there like sectoral preferences? Is it the intuition? Is it the art plus science? How do you distinguish one versus the other?
And it's as far as you ask me a personal question or from the point of IPV, I can answer from personal point of view. I would like to fund any person wherein I don't mind working under him, under her. If I can work under her or under him, I don't mind funding that particular startup. That's what my personal criterion has always been. Now, when it comes to democratic setup like IPV, here what we do is we generally insist on giving a lot of weightage to the leadership. We give a lot of weightage to the leadership. You see, I'll give you one simple example. PT, polytetraethylene or whatever we call it as, is a chemical component that whether you produce or I produce or he produces, it's one and the same. The process is same. I think doctor will also agree that it's the same process. But how come that a company like Reliance or Vimal Fabrics in those days made it the way they made it when compared to Nusli Wadia who made it Bombay Deng? How come that Bombay Deng did not make it the way as big as Reliance? It is the founder that makes a difference. Whole lot of differences with the founder and the leadership. I totally believe in that part of the story. Though we always believe in process-centric approach to business, it is the personality of the leaders that lead to the next level of growth and they drive the particular thing. You know this country is led by a person, a cabinet of ministers. Why do you say that he is a great leader or something like that? The entire human race so far, whether you will agree or not, has always been led by generals and great people, and that's how the whole world will continue to live. So it is leadership. You find a leader, a great leader, who can face adverse situations, who can take up the challenges and take it to the next level. I am prepared to bet my ass on him.
You are very candid.
I'm
You're
sorry.
actually telling people I'm an adversary. You're banking on leadership, which is fantastic actually, because a lot of, but I'm not sure how many founder VC funds are out there who are so founder centric, who can really believe and back the bunk. I will also like to hear from others. And yes, so what is your approach in terms of your funding up methodology? We heard from CGTMSE, they have it's a government institution. They're coming with a purpose. They have said how they have evolved. There's no bar. He said, Shrija, we are founder-led driven leadership. What is your investment philosophy?
Right. Thank you, and appreciate all the panels and the people. See, I represent SucSEED, and we are also an angel investment network. We do look for founders, but we understand any kind of startup is not going to be able to kind of hit everything all out of the park. We expect them to bring something unique, right? Might be they say we are good at technology. Well, they might not have the operations, they might not have the people, they might not have the leadership, they might not have the sales and marketing, right? But they have something which is unique, right? Or they might have like, okay, we are good with the fund financials, we are good with sales and marketing, whatever be their USP. And we feel that there is sufficient amount of good kind of strengths in the other areas, then we will kind of think that they are fundable. Doesn't mean that we will fund them, but at least that is the basic criteria for thinking them eligible. Then if we kind of look at other things, management of the leadership is very important, right? Are they able to kind of take it from where they are? Because it is a difficult process. And we are looking at companies which are really innovating. And as it stands, innovation is difficult, right? Be it technology, be it operations, be it process, financial, ecosystem, it is difficult. So it is going to kind of sap a lot out of energy from the founders. So we see for that mental strength that they are able to think. They are people who would like to work with them, and there are people who would like to work for them. When some of these criteria fit in, then, and they have like at least gone past the basic signal to noise ratio in terms of what they are doing, right? Be it a technology, at least they have something to kind of say that, yeah, they are there. They might not be able to kind of prove a point also with the technology, but at least they have reached the stage that we think that this is a horse that we can bet on, right? We do not need a finished product. We need a valid thing that to prove that given the resources, given our kind of ecosystem that we can put around them, that they would be able to succeed. So we think of them as, yes, a raw talent and we try to kind of build it around them. So we are trying to kind of see if this is what we have right now to work with. If we're building the rest around it, if we think that we can make them succeed, then we will fund them.
So basically you are IP scouting. You look at technology. What is it unique patent? Is it a unique sort of, you basically are sort of more centered around technology, right? Patent, yes. Technology, and you put in the tools required to make it successful.
Correct, right? Means we always invest in companies that are in technology, right? It doesn't mean that they are only tech companies, like we kind of do invest in, like might be logistic companies, but we would not invest in something which is like, has got nothing to do with technology, right? So we are an innovation fund. So that is our kind of guiding principle. But when we do look at some of those, the reason why we think about technology companies is because they have advantages over other kind of companies, right? Once the technology works, the ability to kind of scale, the marginal cost of the additional customer, those are very low. And we appreciate that. So it might be like, Leo here said, we are looking at it from our own point. Given this much amount of money that we can spend on you, what would be the returns? So any place where the marginal cost of the next customer or marginal cost of scaling is low, that is beneficial to us, right? But it is not an adversarial relationship, as I would think, right? It is more, if you do not make money, we do not make money. So we might push you hard, We will kind of say like, okay, you need to kind of do a lot of things. But it is to kind of make sure that you succeed too, right?
How much have you put to work till now? And how have these companies grown on?
Our portfolio is around 69 to 70 companies. We are already kind of funding more.
And what are your check sizes like?
It usually starts off at 1 crore, right? In our portfolio, we have, might be around 10 or so which have gone past, like not just the 0 to 1, but they are now in the 10 to 100. So those would be like in the 100 crore range. And we have got at least like 8 to 10 of those. Between the 1-2 thing, we have got like the remaining 70 or so.
So you put in a check size of a crore?
We start at 1 crore, then we would kind of, if you kind of do the 0 to 1 journey, we will give you 4 crores, just 4x of that. If you kind of do the 0 to 1 journey, so for the 1 to 10, we'll give you 4x of that, which is 16. And that's how we work.
So your max is 16 crores?
Yeah. And by the time we think you're ready for
Series A, Series B.
And we will then introduce you to the Series A VCs.
Wow. And how many of your people coming from your school, I would say your batch, have successfully landed a Series A funding till now?
Well, we are working on that. It means we have got 10 who are almost there, right? Now I think we're just waiting for the stars to align.
Oh, so you have not had any exit till now?
No, we have had exits, but we have not kind of had something which is basically at a Series A level, right? So, we have not had those big ones yet.
Okay. What about you? We heard the philosophy of all the three gentlemen here, then I will come to the lawyer.
Yeah, thanks, Rita. So, no, first of all, I would say, just give a background. I'm investing since 2007 into startups, and I see a lot of different startups coming then and startups coming now. Okay. So personally, I have done like more than 40 AIF investment, fund investments, and around 25 exits. So I've seen the like complete exit life cycle, how it is done. So those time, I mean 2007-8, when we used to do investment, the average age for startups, or I would say the founders, was used to be 35 plus. Okay, people who have done something in life 10, 12 years, I mean, gained some experience, and now they wanted to come into startups, right? Now today, when I look at startups, I mean, most of the people, like 80-90% are like 25, 26 years of age, which is good. But the problem is, a lot of people with that kind of a background, they don't know what is a startup, right? Or they're doing startup only because their cousin is doing it, their friends are doing it, okay? And also, let me tell you, I mean, they're not married and they want to maintain a very good girlfriend, and that's why they're doing it, right? So it sounds cool. I own a startup, I mean, but is it sustainable? I mean, are you a fundable startup? As Anil sir said, I mean, all those people are fundable. See, being a startup, you will need funding, right? I mean, you may be a subject matter expert, you might know a lot of things, but funding is where you will need some kind of a funding, be it debt or equity or whatever, grant or something. So funding will take you to next round of like growth into your startup, and maybe so. And that I tell this because I mean, see, this is a very important step in your life, right? 25 to 30, 32 is what will decide what you're going to do in next couple of decades, right? So you have to use this period very, very well. Okay, and whatever startups you are doing, it's not working out, leave it, do some other startup. But you have to be very, very serious in what startup you are doing, right? That's where you see a lot of rejections. I mean, they go to a lot of VCs or funding agencies, and you see 90-95% getting rejected only because of they themselves are not serious, right? And they have some idea, I mean, they're not worked upon it. They don't know what is the business model, who are the customer, they don't know about the market, and they are going for fundraising. So do your homework well. I mean, that's my first suggestion. The kind of investment we are doing, basically see, we are right now sector focused fund. So we do a lot of food, agriculture, healthcare, and climate focused investments currently. Typically investing from $1 million to $3 million. That's our typical ticket size. So I would say we do stage wise, we do all kind of investment. We have done pre-revenue as well, and we have done typically Series A, Series B investments as well. So the differentiation what we bring into table is like we do a lot of operating support. So we are an investment team of let's say 7-8 people. I mean, that's I would say a decent team size, not big, not small, but we have a very 8 to 10 people strong operating team, right? And these people are like PhDs into their field, right? So we have like medical doctors, PhDs into seed, PhDs into food technology. So these are like very specialized people who have done something into the industry, and they are like very knowledgeable people. So when we invest, we make sure our operating partners come into picture after our investment, and they support the startups in maybe getting contacts, getting market access, getting strategic investor into place, or maybe even helping in IP filings, getting access into different markets. So we help our investments a lot. So that's why we don't invest into many companies, right? I mean, we invest into a smaller number of companies, but wherever we invest, our model is to get involved, through our operating partners, and make sure we take it to next level. So yeah, and a lot of our companies have got like Series B, Series C round of fundings as well. So.
Thanks for that. So I think one key takeaway for startups here is that, see, ultimately the color of the money is green. You raise money via debt or via equity. But as a founder, you have to understand one very basic thing. If you are getting a VC or an investor on your cap table, first ask yourself what he or she is bringing along with just money. If you are just going for capital, then you would rather take debt. Because if you are taking debt, you are not doling out equity. You are not doling out ownership. Please understand, the VC capital or the angel capital is coming at the cost of ownership. Somebody is taking 20% or 10% or 5% of your company in lieu of 25 lakhs. Whereas there's a bank which is giving you a collateral-free loan up to 5 crore at a subsidized interest rate, saying that reach to a certain level up to 5 crore and then raise a VC funding. That is number one. If it is only about money, because the color of money will be green, guys, if it stays equity or debt. That's the question the promoter have to ask yourself. Second, If I am at all raising equity, if I have convinced myself I don't want to deal with the bank, the hassles, even though it's covered by a guarantee unit like CGTMSE, then ask yourself what he or she as a fund is bringing to the table. Will he get or will he open doors to my first set of next 10 clients? Can that VC guy do that? Is that VC fund having deep expertise in a particular sector which I am building on? Number 3, can that VC guy help me in finding a co-founder? Number 4, can that VC validation help me finding a good team? Some of these questions as founders, you have to constantly ask yourself. Just don't go about raising money as to who puts the check at the lowest valuation. That's a dumb way to raise money, especially in 2024. If you are building your startup for a long term, and if you are in there for 10 years, 20 years, if you have that resilience, so be smart about it. You worked so hard for your startup. You left a corporate job. You are hearing from your wife. You're squabbling with your mother for your startup. So might as well make it worth it. Now you've heard from all these people what they bring to the table, the debt, the equity, the styles of investing. Here is a lawyer. Now, a legal perspective is also very important. Because when you raise money in debt, it's simple. It's a bank. It's a simple document. But when you deal with these people who are VCs and angel investors, you will have to sign something called a term sheet, right? And a term sheet is an important document. So please understand what really is a term sheet, what you are signing for. And don't ever be casual as a founder when you sign a term sheet. Because you might think, I'm a product person, I will raise money, I'll make it big, but no. You will be held answerable to your term sheet. That VC will hold a noose around your neck and gonna come back very badly on you if you do not abide by that. So here's a lawyer, and I would like to ask him that what are the key things as an entrepreneur which I have to be very, very careful about when raising money from a VC fund, especially from term sheet perspective.
Hi. So I bring up the boring part of the conversation, but therefore I've been...
Not the intelligent part.
No, it's a very important point that you've mentioned. Don't be casual about your term sheet, and that is very important because what goes in the term sheet, while you could still negotiate it post the signing of the term sheet, but your expectations are set. Expectations from your side, expectations from the VC side. From your side, you would assume, if you're casual about the term sheet, you would start assuming that it's fine, sign up to it, lock this in, we will negotiate it during the documentation stage. But from a VC's point of view, they come with a certain parameters. They're saying that, listen, I don't want to waste my time and money pursuing something unless I know that the principal terms are agreed between us. Sorry. That's where the first disconnect happens. And that is where when Sir was saying, we tend to place ourselves in an adversarial role. It's not technically, you are aligned to an extent, but the misalignment starts when you take a casual approach to the term sheet. While the VC partners are also interested in your success, obviously as a startup founder, you're interested in the success of your own startup. Their disconnect starts when they say that what you've agreed in the term sheet is not something I can deliver anymore, documentation has to be discussed, or we need to have further amendments to documentation. Confidence starts getting shaken. Right? The monies are sunk in, they're responsible to their investors. The next round starts getting questionable. The new VC who's looking in, new private equity guy who's coming in, he's going to ask you certain questions, saying, why were certain amendments done? What was the original term sheet? Why were the deviations done? What was the originally agreed business plan? Why did you change from that? Any improvement is always welcome. But any moving downwards is going to start raising questions. Take example of you starting a company with your own co-founders. Now, if your co-founder promises you certain things, and then he comes and tells you, or he or she comes and tells you that, listen, I know we've agreed that I will do a certain part of the job, which I no longer are able to do it anymore. So let's rethink how we're going to get. Do we get in a new co-founder? Are you going to take additional responsibility? Or do I sell a certain part of my stake? 100 questions keep coming up, and it starts getting a little jittery with everyone. Which is why the point saying that don't be casual about your term sheet. Your term sheet will have to tell you what exactly you're looking to do, what is the company looking to do, how long do you want the investors to stay invested, what are the terms that they'll be investing in, how much equity you want, if you want the equity in the form of equity plus a certain portion to come in as a debt, all of that your term sheet needs to capture. Having said that, it's not cast in stone, right? There are mistakes that will go into term sheet because term sheet is to kickstart the discussion process. And VCs understand it, startup founders also understand it, that this is a high-level discussion that we're capturing, but those high-level commercials should not be misrepresented and misinterpreted as well.
These are sort of very good points in terms of term sheet. And I think also because we are in Hyderabad, which is the AI capital, I would also have one piece of advice to entrepreneurs out there that all of you, I find, and I was going through some of the backgrounds of the people who are attending the conference today, that there's a huge bias towards knowing the technology and ownership. I know this very well. I'm a great person, semiconductors and robotics, AI. But if you are somebody who has built something very unique, go and patent it. It is extremely advisable. Spend money on copyright. Spend money on patenting it. Spend money on ownership. These are the investments which will help you and set your ball rolling in the right direction. And I would ask you, from a SucSEED venture and from an Inflection venture point of view, if you would rather invest in somebody who has a patent in his or her name, or just coming to you and saying, I know this or I know that, whom would you trust more?
Understandably, an inventor of any idea or any product or any intellectual property would always be preferred as against a generic approach to the business model. We come across such kind of people, especially currently in the areas related to deep techs and stuff like that. We come across such kind of inventors, you may call them as. And most often than not, they are aware of, because intellectually they are very sound and intellectually they know what they are doing. So they would have been told by somebody to file those patents. They have been told to see to it that their corporate or intellectual properties are patented or whatever it is. So they do come to us, and we respect them, and we understand that there is an opportunity for us to really back such kind of things. Especially in recent times, we came across people who were into identifying a futures to a crypto deal. I couldn't understand anything out of it, but then, well, he actually had that IP for it. And he could do that. He said that this is what it is, and then Beyonce actually is backing it up with a $300 million kind of a fund. They are backing it up. So we realize that yes, there is an opportunity. There is a great opportunity for us, and the inventor is also respected by us. That's for sure. We respect them.
So, but tell me one thing: how are VC funds upskilling themselves? There's just so much capital out there, right? So how is one VC fund different from the other? Like how are I think this is the era of branded VCs. Everybody is saying, okay, it's Peak 15 is there. There's an Axel Partners. There's some of these. So how are you guys also saying that, okay, this is what we bring to the table?
Fortunately, the founders of IPV have been smart from the day one. You see, what we have done is we democratize the whole process. When I say democratize, I will just explain it in a bit. That whoever gets onto the platform, on the platform of IPV, all of you can be on the platform of IPV, and we offer them an opportunity to invest. When I say democratic, an opportunity to invest in any of the startups with a ticket size of just 2.5 lakhs. And the deal size is as low as $500,000 and as high as $1 million. That's the kind of a game plan. Okay? So all of you are a part of the system. And fortunately, while you are interested in growing or multiplying your money through us or through a collective decision or the, don't call it the herd mentality, a collective way of doing things. We always have, believe me or not, at this point of time, among the 21,000 people on the platform at this point of time, across 45 nations, there are at least 350 subject matter experts on anything and everything under the sun. Anything and everything under the sun. Believe me, trust me. I look after one of them, but then there are much erudite people, educated people, people who have put in some decades of experience in areas which are in AI, which are into robotics, which are into ML, which are into, name it, you name it, healthcare. You talk about in healthcare, we deep dive into healthcare. Look into circular economy, look into social impact, look into anything, agriculture, agri-tech, med-tech. I think we backed up all kinds of things. We are sector agnostic, and I think today we have got on board at least 300 plus subject matter experts. And it is not democratic. It is not, they are not paid for, they just sit down and then they evaluate the entire thing. That's how we do it. So I think we are done. Therefore, you see, out of the 217 and odd startups that we have funded, I think we were busted only in 13 or 14. Rest of them have all gone to the next level, or we have exited out of half of them.
Wow.
Thank you.
Wow. From a SucSEED perspective, I want to understand from you that you said that, Shrija, we're yet to see, the stars are yet to align. We're yet to see a big exit there. So what have been the learnings from that front? I want to also, because I have to understand from you that suppose if a startup entrepreneur comes to you, what really are the 2 or 3 common mistakes that they're doing, which comes invariably in different parts of the conversation, the common mistakes done by the entrepreneurs?
I'll answer your question. I just wanted to kind of add something to the intellectual property thing also. Right? See, we have got IP which is either offensive or defensive, and in your patents. And I think you should be judicious about what you think your patent is and not spend money just to file it. I have found that 80% of the patents are absolutely a waste of time. So unless you are very clear that I'm filing it because I need defense or it's going to be an offensive, then file it. Otherwise, ignore it, right? You'll save yourself a lot of things. We look at the patents. I have looked at every patent which has been filed by any of the startups I have reviewed. And I have not found a single startup. I have at least 30, 40 patents which I said that it is of any value, right? They do put some value to it, but it is very marginal, right? That is my personal experience on patents, right? It doesn't mean that I would discourage you, but I would kind of look at the idea, see what exactly it is, what timing you are putting it, and then go ahead and spend that kind of thing, right? Now to kind of really answer your kind of question, right? You had a long question. Can you just kind of break it up A, B, C for me kind of thing? I want to answer each and every one. That's the reason.
Yeah, no, the common mistakes done by entrepreneurs.
Right. See, I think I'm good to talk about it at different times, right? I think one is basically kind of the term sheet portion, right? Being casual, right? This is absolutely a contract, right? We're going to kind of work with you, but you expect it to be thing. We have found some kind of founders who basically like to say, okay, now I've got your money, I'm going to deal with it as I want, right? And that becomes a very adversarial relationship, right? We're not here to kind of run the startup for you, but we definitely want to protect our money, right? And that becomes the first kind of thing, right? Now, the second kind of part is basically thinking about your kind of things that you're doing, like might be technology, might it be operations, might it be the finance, whatever, right? Or growing your customer base, any of those. Quite a few times, the founders have seen that, they're good in one area, but they do not, right? And they do not have a sufficiently complementary team to kind of fill in those gaps, right? I might be good at one part, and they always miss their numbers. And then it also kind of becomes a thing, right? Well, they might be not failing, right? But they are not growing at the right level, which will help me kind of be confident that I want to invest in them the second time, or I want to take it to the second kind of external kind of VC or something to kind of get them the next round, right? Because they are just kind of a linearly growing business rather than something which is basically kind of giving you that incremental returns. They are not increasing it at a rate of level which I want them to, right? So that becomes again a very different, because then I'm losing interest in you. So that operational efficiency is basically kind of hitting. Right? And the third portion is, you feel that I've been running this show, and there are just people like, I would kind of say like Kishore Kumar. You have a music director, Kishore Kumar never listened to him, right? It is exactly that person. He's going to put in his thing, right? If you are that kind of person, it is going to be very difficult for you to kind of work with any kind of VC, right? Doesn't mean Kishore Kumar was anything short of great, right? But you have to be that, and then people will tolerate you, right? If you are just that average kind of startup, right? It becomes far more difficult to kind of know he's kind of just vagrant. He's like basically kind of changing directions without really concentrating or taking us along on the journey, right? You understand, when you have invested money, right? You have given up a portion of your equity. You have given up a little bit control, right? And it is up to you to take the partnership along, right? If you do not think of that, I said I am the majority owner. You might still be the majority owner, but you have to take your partners along. We are those partners. And if you do not, it becomes a little bit difficult, right? So those are the kind of things that kind of really, right from the starting to the operations to the thing. And so many times in exit also we have seen that where people kind of are only trying to kind of protect himself at the type of exit. Might not be even looking after his own team, his people, or other kind of VCs might have come at different stages, right? So we have seen multiple things that fail, right? It is, again, transparency, willing to kind of compromise, that kind of thing. And sometimes people just kind of say, it's my way or the highway, right? And that kind of makes it very difficult. So this is how, across the journey, we have seen problems.
Thanks. I want to come to you. You also said that, Shrija, the face of entrepreneurship has changed from 35 to the average age of entrepreneurship coming to 22, 23. I think much of that also is because we are in the Shark Tank age of entrepreneurship. We are being so overawed by what is being shown on national television that there's a lot of over-romanticism happening, that people are romancing entrepreneurship. But the problem with over-romanticizing anything in life is that the cost of that is borne by your family. If you were to go down under today, your wife will bear it, your kids will bear it, your parents will bear it. So I think take a decision which is very informed. And I think I keep telling this to the entrepreneurs, and which is why forums like this become very important, to find the signal in the noise. I personally see that when I started, sort of 2010 was a time when I think the entrepreneurship really came on a global map. I think we had more opportunists then. They were the entrepreneurs who used to find, basically, who used to pounce on an opportunity and make good of it. Like in the COVID time, we saw people providing these services to COVID patients and all that. COVID happened, Chinese apps were banned, so you had entrepreneurs coming up with Indian apps. Then came the people who were the enthusiasts, like which Saurabh was also saying in the AI panel, that everybody's talking about AI, but what problem they are solving, they don't know. It's like they have a hammer in their head, and they're just having a solution, but they don't know the problem. And then they're the illusionists, right? People who'll give you a mirage of a big problem that they're solving. Shrija, I'm building for metaverse. They don't know where is metaverse right now. So I am seeing more entrepreneurs in the bracket of the second and the third than the opportunists right now. Everybody's wanting to build an AI company. Every pitch deck that we see is .ai now. If it's AI or not AI, there's a lot of AI washing also happening. There's a lot of blockchain washing happening. So as VCs who are putting money into work, how are you telling your mind that I have to stay away from this fad? If I don't understand something, I will stay away from it, no matter it's a very big opportunity which other VC will come on. How are you putting that discipline into you and your fund?
So when I talk about entrepreneurs like getting lesser rates, that's a problem with Indian VCs as well. If you go to US VCs, everybody will have like white hairs, right? And Indian VCs will have with black hairs. So, so that's and the point is, I mean, a lot of VCs here don't have experience. I mean, that's a fact. So VCs there will start their journey after 55 years of life. I mean, they have done something, performed something, and now they are advising startups. That's opposite in India. So I mean, to your question, I mean, how VC will like, I mean, so a new age VC, I mean, who is like very young, I mean, he's starting a fund, and today we see 600 funds registered in SEBI right now. Okay, they are making some kind of investment. And VCs are also 25, 20, 30 years of age right now. I mean, like startups. So VC is also startup business, right? So my point is they have not seen that ups and downs. So let me tell you, when we used to invest initially those point of days, I mean, there was Fed for infrastructure, then came microfinance, then came e-commerce, then came fintech. Then so I have seen so many ups and downs. I mean, I know a lot of my colleagues here, they have all seen that. So we know that whatever be the flavor of the season, that does not make you like successful. If you are in the same business, it doesn't mean you'll be able to raise fund. Just because you are doing AI, or just because you are doing fintech, or just because you are doing e-commerce, that does not mean you'll be able to raise money from a VC. So a VC invest into very less number of companies, right? So they look at 100 companies, maybe 100 AI companies. Let's say I'm AI focused only, right? So I look at 100 AI companies. So I understand what exactly works, what doesn't work. So, and they invest into maybe 5 or 6 or 7 companies out of 100 companies, right? So that's the ratio of investment getting funded. Over all these years, over 15, 16 years of my experience, I would say, a lot of startups I meet, and after 3 or 4 years, those startups are not there, unfortunately. It's a very unfortunate part. So we keep hearing about startups which are successful, and we keep clapping about those people, but yeah, there's a high casualty of 80-85% of a startup not even crossing 5 years of age. Right? So we need to be very careful. I mean, whatever startups we are doing, so many challenges are there. I'm not talking about startups, unfortunately, which have not got funded, but startups which have got funded, casualty of 85% is those companies. I'm not talking about unfunded ones. A lot of mistake all the startups do, right? They start money, I mean, the moment there is funding, they start spend money into unnecessary things, right? Buying a expensive car or whatever. A lot of startups, they don't have a founder, co-founder. I mean, it's very much required right now. You cannot be a single co-founder. You have to be a 2 or 3 co-founder working, having different complementary skills. So yeah, to answer your questions, I would say VCs have evolved. I mean, I think every VC is hearing maybe on a weekly basis 30-40 pitches, right? And a lot of times, I mean, even good companies might not be, we might miss the good companies as well. Okay, so for difficult job for us as well to find good companies, and for you as well to find a good VC, because there are a lot of VCs, 600 VCs, as I told you, in the market. If you get stuck with a bad VC who doesn't understand your business, who is not able to help you, then maybe you might be in the 85% casualty range. So you have to be careful on that.
Yeah, I would say choose wisely, and there are about 130,000 startups in the country, and I would completely agree with what you were saying, that data says that about 80% of them don't make it to the 5th year. So we have to understand these startup realities. I come to you now that if you were to give one advice to the VC investor and one advice to the entrepreneur friend, what would that really be, having gone through so many deals now? And I know Khaitan has worked across large deals, big deals, small deals. What is that underlying sort of guiding principle that an entrepreneur should not lose handle on, and one advice to the VC?
I mean, that's a tough one, but I would think it'll probably be learning to let go of positions. In our experience, we have seen a lot of people negotiating or trying to close a deal based on egos. One, the founder is saying, I'm doing something which nobody else is doing. VCs don't understand this. VCs come with, if I don't fund, he's not going to go anywhere. But positions start, right? But eventually, a lot of transactions, people become friends. People become close friends. Relationships are built. Those are the places where both the parties have been genuine with each other. Each one was interested in the success of the other person. So if you ask for an advice as such from me, it would be constantly evolving and ability to pivot and certain amount of effort to ensure relationships don't sour.
The relationship in the process should not sour. I think that really is a fundamental of anything in life. I want to come to you now, sir, that you're hearing from your counterparts on the equity side. You're hearing from a lawyer also, ultimately some of the relationship. So, sir, if you were to give an advice to a startup entrepreneur who has this fancy idea about equity and VC, how would you tell them to look at a bank as debt? Why aren't they looking at bank as a friend?
See, right now this is, if I have to say, each and every bank has got one VC fund. They are managing. From CB point of view, basically I am from CB, so from CB point of view also, we have got various varieties of funds are there. For technology, for software, for that, this and all, there are around 15 to 20 varieties of funds are there. The only thing, right, people are saying that the right person to select the right fund, but entry is very, it is not very easy to anybody. Just get in, explain your project and take the check and walk out. No, it cannot be. There is a good stringent process is there that has to be passed through by everybody. But only thing is that what I understand, because I am participating in many meetings organized by this MSMEs and other this one. So everywhere, this awareness of venture funds, what are available with various banks, that I think many people are not aware. So from government point of view, if any such support is required, we also propose with various banks to give a lot of awareness to the public, the real ventures and the startup people to get the assistance. So I think there is some action is going on from ministerial side also. Soon that would be come out. And they are planning some more awareness programs. So people will come to know that, and I think soon that will start. Then people will come to know what sort of funds available and where to approach and how to get that sanction. And all those things can be known to everybody. That is the only thing. Otherwise, there's no way other way to approach bank. And bank has no shortcut method to sanction anything. Every bank has got a stringent procedure to sanction that.
Great. While we're talking about debt and equity, we also have a product called venture debt. And unfortunately, we don't have anybody on the panel representing that. So why don't I have you to spend about 5 minutes to talk about venture debt, what it really does, and how it can be very beneficial to entrepreneurs. It's a venture style kind of tool and not to dole out equity. You want to take a stab at that?
Sure. So venture debt is equity model in a debt form, right? The easiest way to understand it. You don't have compulsions for example, let's say you take a bank loan. You don't have compulsions on your interest payments, you don't have compulsions on your principal payment, etc. The venture debt, there are a lot more understanding on the security that you can offer. So it's a quasi debt is where I put it. It stands somewhere between your equity and your regular bank funding.
Okay, now it's time for some rapid fire, and I'm going to begin with you. Okay, if you have to name the most overrated entrepreneur in the country right now, who would that be?
Ashneer grower.
Okay, which is the sector which you find is the biggest fad right now?
AI.
Okay, I come to you now. The same question, the most overrated entrepreneur.
Well, I wouldn't kind of go there, but I'll give you about the sector, right? I don't think AI is the overrated sector. I would think our kind of food startups would be the ones.
It's a message for you. You invest in food. He's just saying your food startups are most overrated. You have a response for him? Okay, but you have to answer my question that what do you think is the most underrated idea in technology right now? You're thinking?
Yeah, I'm thinking, but I would be very difficult to kind of put it, but if I had to choose, I would say even AI right now. It is underrated.
There's a company raising $150 billion and you call it underrated.
Yes.
The potential of it.
Yes, the potential. There is AI is going to be the biggest game changer mankind has ever seen till today, right? And what we are seeing is just the beginning. It is far more important in future. Means people say that we are going to go to war for water, for air. You are going to go to war for control of AI in future. So I think it is such a radical paradigm change. So it is underrated. To me, OpenAI is underrated and what they're doing.
Fantastic. What about you, Anil? The most underrated part of technology, which you think right now?
In technology terms, very difficult. But then the one that occurs to my mind obviously is AI. Right now, whatever is evolving and the way the size is humongous. It's humongous. It's underrated, yes.
And the most overrated entrepreneur, according to you?
I think I don't know, but I always liked Ashnir. Don't say that. I always liked him. But I think Kamath, zero da.
Nikhil Kamath.
लगता है maybe don't quote me ever.
You're quoted now. You're on the camera.
Shit, man. That's the thing. I think is overrated. I think.
Okay, so I come to you now, sir. One advice that you would have for startups, what would that really be as they're growing up their ventures? One like which you think you would have gotten in your 20s?
From CGTMSE point of view?
Yes, sir, you could say that. Yes.
As Murthy point of view. That can be there.
I don't know. Advice means, see, right now I'm there in guaranteeing business. We don't have any bar. Even startup also we are giving guarantee. So we have no issue on that. So I'm not so expert in that to give any advice, because if I'm there in banking business, definitely I would have suggested certain things. But now I'm in guarantee business. So from my side, even if a startup is coming to me, I'm ready to give guarantee. I have no issue on that.
Okay, sir. I come to you now. You were saying that the AI potential is completely underrated. Why would you say that?
Well, I don't have hard facts.
You have to give like
I
a
don't have
proper
hard
answer
facts.
now.
I'll tell you, my understanding is we are at a stage where when Steve Jobs first said, I just want the computers to say hello, right? That's probably where AI is right now. And this AI has started, the understanding of AI has probably started, and everyone here is better placed than me to give you an answer. 2019-20, people were discussing this for last 10, 15 years. We had an understanding of Internet of Things, which we thought was AI. But the actual surface is being scratched only the last 4 or 5 years. Overrated sector. I think the experts here will be able to tell you that better. Overrated sector, I don't know. I really don't know.
Okay, right. The most difficult deal that you've cracked in now. An experience you'll always remember.
Quite a few, actually. Some I've run for almost a year. The most difficult ones is not the deal as such, it's the managing expectations, managing different parties to the deal. Because everyone comes with expecting that certain things will happen, that they'll get a certain portion, or we'll be able to finish certain things, or for that matter, that in 3 years' time we will achieve a certain thing. And then they realize, or someone said something at a meeting, and then that flares up egos. And I've seen battles that have gone on for the last 20 years. Because in 2007, 2008, one particular promoter had looked at an investor and used a certain word, and the investor was not willing to let it go. And it's in Supreme Court right now, because of one word being uttered in a boardroom.
Wow, that's like some ego battle there. Okay, can I sort of hear it up from the audience for this panel, which sort of really shared some insights? I think we had a very wonderful panel here. I know you have a lot of questions because all your investors are here. I can just give 2 questions from the panel. Yeah.
Good afternoon, sir. Sir, after lots of struggle, I have started own business in 2018. It's others' idea actually. My idea is not started. My question is, just now Ma'am asked that overvalued ideas and undervalued ideas, what are the course. So I do lots of homework and I got a conclusion that it may not work because many competitors are there in the market and I am not able to step up because of afraid or any negative thoughts. So I am not concluding that it is overvalued or undervalued. Can you suggest me in that way? How can I find it right or not? Just I want to start a electronic waste recycling company.
You have a particular idea which you want to understand if it's good or not.
Yes.
Electronic recycling company.
Yes,
Yeah.
I want to start. I will do homework and I will think, so many companies are there. What is my percentage? How much I have to work? Is it profitable or not?
Fair question. Let him answer the attractiveness.
Recycling of any of the electronic products or any of those electronic goods that you want to do is a very viable business, and it is at a scale it is very great.
Yes.
The amount of money that goes in to extract gold from the mines is far, far, far higher than extracting it from the electronic waste. Please remember that.
Yes.
It's a fact, proven.
Yes.
You can do that. But the question is, what kind of money? What did it requires? Believe me or not, I should not use it. It needs shitload of money. So that if you can find it, do it. If you don't find that kind of money, don't do it. Be happy.
Okay.
Be happy that you have got one connector which has got some 24 karat of gold there. Thank you.
Yes, sir. Thank you.
Okay, there's another question. Yes.
Hello everyone, I'm Kanishka from XSEED.io, a startup in T-Hub, as well as we have an office in Hapsiguda. I'm a second-time founder. The first one was in 2009 when I was just out of college, when the average age was around 35 years when investing, and today I'm 35 and the average age is 25. Okay, so that was a little funny for me, but that's a fact. So I took an exit in 2021 with my first startup, started again, and there are a couple of people on the panel to whom we've approached for funding as well, waiting to hear from you all. So when it comes to CGTMSE scheme, would like to understand, we've done a revenue, X amount, and we are looking for 5X of funding. So what are the important factors apart from revenue that you look to invest in? Because the fund that we are raising right now, both equity as well as through debt, is mainly for upcoming projects. So is it something that you'll consider?
No, that's what I was saying, that I'm not a lender, very first point is that.
Yeah, not you, means
So
associated banks.
I don't look into all those points at all.
Okay.
If somebody, lender is lending to you and lender wants to cover that account under CGTMSE, I'm ready to cover that.
Would you recommend the right banks? Because the banks we approach ask for revenue stream, and then we have to go
Each
back.
bank has got a different stick to lend to the people.
Okay.
Right? That has been decided by their boards. Even Reserve Bank of India has not stipulated any standard lending procedure to all the banks.
Okay.
So there is no good bank and bad bank, but only thing is that whom you are approaching, and if he is able to understand your project properly and he is fine with your net worth and other parameters, there should not be any problem in lending to you.
Okay, sure. Sure, I'll connect with you again regarding this.
He has a presentation on CGTMSE,
Okay,
non-collateral loan up to 5 crores.
I think
What
that
really
would
is
be
the process and methodology? I think that he can clear that also then. Yeah. Okay, there are a lot of questions, yes. Yeah.
I would like to listen your opinion on building a startup in Bangalore versus Hyderabad in terms of growth, funding.
It's a dangerous question, especially sitting in T-Hub.
Especially sitting in,
Yeah, I would like to know, but
yeah. Don't go to Bangalore, stay in Hyderabad. Very simple. Don't ask more questions.
No, I think he is right. I mean, Bangalore used to be a great place, but Bangalore is now getting costly in terms of hiring skills also. I mean, hiring skills in Hyderabad is much, I mean, I would say slightly lesser, and you will get the same talent as Bangalore. So I stay in Hyderabad.
thank you.
Thank you. I think it's been a very meaningful panel, and I just hope that you all have had significant takeaways in terms of while you're growing your startup, at what stage, what kind of investor to get in. If you are up to 5 crores, what kind of investor to get in? Is it a bank or an investor? From 5 crores to 10 crores, if you are looking at a VC fund, is he or she bringing more than money? That's a question you have to ask yourself. So I think we had a very meaningful panel. And if there's anything that you guys want to ask, I think you guys are around for like 10-20 minutes now, I'm assuming. So please grab a chance to sort of get hold of them. We also have members of media who also have questions for them. So please make most of your time. And thank you so much for coming in. Thank you. Thank you.